How does the US Federal Reserve's battle with price pressures affect other central banks' plans to reduce interest rates? This is the question that investors and economists are currently grappling with. The struggle of the US Federal Reserve to tame inflation has prompted a shift in global investor sentiment. The anticipation for interest rate cuts around the world is being pushed back. Why? It's simple. The Fed's inflation problems are not confined to the US. They have a global dimension, according to James Knightley, the chief international economist at ING in New York. He suggests that if the Fed is unable to cut rates soon, it could fuel dollar strength, causing stress for the European economy and limiting other central banks' ability to reduce rates. There's also concern that the inflationary trends we're seeing in the US could emerge in Europe as well. Now, while senior officials at the European Central Bank and the Bank of England maintain they are not wrestling with the same inflation issues as the US, implying they have more scope to cut rates earlier, alterations in the futures market hint at a different story. While the European Central Bank and the Bank of England argue that they are not facing the same inflation issues as the US, changes in the futures market suggest otherwise. Let's delve into the specifics. How have these developments impacted the European Central Bank and the Bank of England? Well, as the United States grapples with a string of less than stellar inflation figures, there has been a shift in the market's forecasts for rate cuts by both the European Central Bank and the Bank of England. This adjustment is not isolated. It also reflects upon the Federal Reserve's own rate cut plans. Initially, traders had anticipated an average rate cut of roughly 0.7 percentage points by the European Central Bank this year, starting from its policy meeting on June 6th. This expectation has shrunk from a predicted cumulative cut of 0.88 points just 2 weeks ago. And if we rewind to the start of the year, when US inflation seemed firmly on a downward trajectory, the anticipated cuts were as high as 1.63 points. Similar adjustments were noted for the Bank of England. The market now expects rate cuts of 0.44 percentage points this year. This is down from 0.56 points anticipated just 2 weeks ago and a high of 1.72 points at the year's beginning. So, what's causing this shift? Well, the backdrop for this change has been the market's waning expectations for the Federal Reserve, which seems set to maintain rates at their 23-year high at its upcoming meeting. While at the onset of the year, investors had foreseen as many as 6 quarter-point cuts this year, they now expect merely 1 or 2. These shifts in market expectations underscore the global impact of the persistent US inflation problem. In the heart of this issue lies the Federal Reserve's stance on its own interest rates. The Federal Reserve, or the Fed as it's commonly known, has been grappling with its own set of challenges, particularly in relation to inflation. The markets had initially anticipated the Fed to reduce rates, providing some relief to borrowers and potentially stimulating economic activity. However, the reality has turned out to be quite different. You see, the Fed is currently holding its rates at a 23-year high. This is due to the persistent inflation problem that has been more stubborn than expected. Jay Powell, the Fed chair, acknowledged this in recent comments. He noted that US inflation was taking longer than expected to reach its target. This unfortunately implies that borrowing costs may have to remain high for a longer period than initially anticipated. This development has led to a significant shift in market expectations. At the start of the year, investors were expecting as many as 6 quarter-point cuts. However, now they are predicting only 1 or 2. This change in the Fed's approach has had a profound impact on the global financial scene. The Fed's resistance to lowering rates has created a challenging environment for other central banks. If they were to cut rates more aggressively than the Fed, they risk damaging their own economies due to the potential impact on exchange rates, import costs, and inflation. Thus, the Fed's stance has inadvertently placed a limit on how far other banks can go in terms of their own rate cuts. The Federal Reserve's cautious approach has indeed sent ripples across the global financial landscape. Its struggle with inflation and the subsequent reluctance to cut rates has not only influenced market expectations, but also shaped the strategies of other central banks around the world. As we move forward, the actions of the Fed will continue to play a crucial role in the global financial scenario. What happens if other regions cut rates more aggressively than the Fed? The repercussions could be severe. Indeed, as we delve into the potential consequences for other economies, it becomes clear that a balancing act is in play. Let's consider the scenario where other regions, such as Europe or Asia, decide to cut their interest rates more aggressively than the Federal Reserve. This could lead to a series of ripple effects. First and foremost, the exchange rates could fluctuate significantly. A lower interest rate usually weakens a currency, as it decreases its attractiveness to foreign investors. This could potentially lead to a stronger dollar, which might not bode well for economies heavily reliant on dollar-denominated debt or those with large dollar reserves. But the impact doesn't stop at exchange rates. Import costs could also be affected. A weaker local currency makes imports more expensive, which could drive up inflation. This is particularly concerning for economies that rely heavily on imported goods and raw materials. Inflation itself is another beast to tackle. Lower interest rates can stimulate spending, and increased demand can push prices higher, leading to inflation. While moderate inflation is often seen as a sign of a healthy economy, too much inflation can erode purchasing power and create economic instability. To put this into perspective, let's consider the views of Nathan Sheets, chief economist at US lender Citi. He suggests that there's a limit to how far the divergence can go. Cutting rates aggressively in an environment where the Fed is waiting, according to Sheets, is a more challenging task. This reflects the delicate balance that central banks must strike. On one hand, they need to respond to their domestic economic situations, which may call for lower rates. On the other hand, they must consider the broader global financial stability. Too much divergence from the Fed's actions could lead to unintended consequences, adding another layer of complexity to their decision-making process. Navigating the fine line between mitigating domestic economic concerns and maintaining global financial stability is indeed a complex task for these central banks. It's a game of chess on a global scale, with each move having potential repercussions far beyond their borders. Despite the pressures, top European central bankers insist their less serious inflation problem requires a different response. Indeed, the European Central Bank, or the ECB, finds itself in a slightly different boat than its American counterpart, the Federal Reserve. To add some perspective, let's turn to the insights of Marcelo Carvalho, the global head of economics at BNP Paribas. Carvalho posits an interesting viewpoint on the ECB's position amidst these global economic developments. He suggests that the ECB is neither Fed-dependent nor Fed-insensitive. This means that while the ECB is certainly cognizant of the actions and policies of the Federal Reserve, it maintains its autonomy and is not dictated by the Fed's decisions. At the same time, the ECB is not oblivious to the Fed's moves. It understands the interconnectedness of the global economy and the ripple effects that can stem from major economic events across the pond. So what's the ECB's response to all this? Well, the ECB is keen to stress that it is not grappling with the same inflationary issues as the US. This might imply that they have more room to maneuver when it comes to interest rate cuts. The ECB is acutely aware of the delicate balance it must maintain, and it is prepared to respond in ways that best suit the European economy's unique needs and circumstances. In essence, the ECB is not blindly following the Fed's lead, nor is it ignoring the global economic climate shaped in large part by the Fed's actions. It's a tightrope walk, and the ECB is working to maintain its balance, keeping the best interests of the European economy at the forefront of its decision-making process. With the market's expectations that high US borrowing costs will limit their freedom of maneuver, It will be interesting to see how the ECB and other central banks navigate this intricate economic landscape. Indeed, the coming months and years will provide a fascinating study in central bank strategy and the resilience of the global economy. In conclusion, the US Federal Reserve's battle with inflation is having a global impact, complicating other central banks' plans to cut interest rates. This video has highlighted the significant shifts in market expectations for rate cuts across the world and the pivotal role played by the Federal Reserve in this scenario. We've also delved into the potential consequences for other economies, particularly in Europe, where central banks are wrestling with the decision to cut rates earlier than their American counterpart, despite the persistent inflation problem. These shifts in the futures market underscore the global reach of the US inflation issue. Moreover, we've examined the response from the European Central Bank, a response that's uniquely positioned between being Fed-dependent and Fed-insensitive. Despite the high US borrowing costs potentially limiting their freedom of action, European central bankers insist their less serious inflation problem demands a different response. As we move forward, the actions of central banks will continue to be closely watched by investors and economists alike as they navigate the complex interplay of domestic economic considerations and global financial stability.